This is a Form ADV, filed with the Securities and Exchange Commission on January 15, 2026, by Bridgewater Associates, the largest hedge fund in the world, managing $168 billion in assets. The form is 847 pages long. It details investment strategies, risk factors, fee structures, and, buried on page 612, a single line item that shouldn't exist. The line reads, Digital Asset Allocation, Direct Holdings, 2.4% of flagship Pure Alpha Fund assets. 2.4% of a $97 billion fund. That's $2.33 billion in direct holdings of digital assets, language that in SEC filing specifically means cryptocurrency held in wallets rather than through ETF exposure. Bridgewater Associates, Ray Dalio's fund, the institution built on radical transparency and principled decision-making, holds $2.33 billion in Bitcoin, directly, not through intermediaries, not through ETFs, actual cryptocurrency, held in actual wallets, controlled by actual private keys. This is the same Ray Dalio who said in 2021, Bitcoin has a good probability of being outlawed. The same Ray Dalio who warned in 2022 that governments would kill Bitcoin before it gets too big. The same Ray Dalio who, as recently as November 2025, told CNBC, I have a very small position in Bitcoin. It's not a significant part of my portfolio. A very small position, not significant, $2.33 billion. Either Ray Dalio doesn't know what small means, or Ray Dalio has been saying one thing in public while doing something very different in private. And the Form ADV, filed under penalty of perjury, audited by regulators, legally binding, tells you which interpretation is correct. The question isn't whether Ray Dalio believes in Bitcoin. The SEC filing answers that question with 9 zeros. The question is why the most influential macro investor of the past 50 years is accumulating Bitcoin at scale while publicly downplaying his position, and what his actual forecast for 2026 tells you about where this asset is heading. Here's what they're not telling you. Ray Dalio didn't wake up one morning and decide to put $2.33 billion into Bitcoin on a whim. Bridgewater doesn't work that way. The fund operates on what Dalio calls systematic decision-making, rigorous analysis, stress-tested models, and investment theses documented in internal research that runs thousands of pages. The Bitcoin position that appeared in the January 2026 Form ADV represents the output of this process. Somewhere in Bridgewater's Westport headquarters, there exists an internal research document, probably hundreds of pages long, that articulates why the world's largest hedge fund should hold 2.4% of its flagship fund in an asset its founder publicly dismissed for years. That document hasn't leaked, but fragments of Bridgewater's internal analysis have circulated through the institutional investment community, shared in conversations, referenced in competing funds research, discussed at conferences where hedge fund principals compare notes. The fragments reveal a thesis that contradicts everything Dalio has said publicly. The thesis doesn't argue that Bitcoin is digital gold or an inflation hedge or a speculative opportunity. The thesis argues something more fundamental, that the global monetary system is approaching a structural break, and that Bitcoin is one of very few assets positioned to appreciate through that break rather than decline. The structural break Bridgewater's analysis identifies is the end of what Dalio has publicly called the long-term debt cycle, a pattern he's written about extensively in his books and research. The cycle runs approximately 75 to 100 years. It begins with low debt, progresses through debt accumulation, reaches a crisis point where debt exceeds the capacity to service it, and ends with some form of debt restructuring, default, inflation, or currency devaluation. Dalio has dated the current cycle's beginning to the 1944 Bretton Woods Agreement. By his framework, the cycle is now 82 years old, deep into the terminal phase where debt restructuring becomes inevitable. The internal analysis reportedly concludes that the restructuring will take the form of currency devaluation, not default, not explicit inflation targeting, but systematic reduction of the dollar's purchasing power to make nominal debt burdens manageable. The analysis projects cumulative dollar devaluation of 40 to 60% over the next decade, achieved through monetary policy that prioritizes debt sustainability over currency stability. In this scenario, assets denominated in dollars lose purchasing power. Cash loses, bonds lose. Even equities struggle to keep pace with the devaluation because corporate earnings are denominated in the same devaluing currency. The assets that appreciate are those outside the dollar system, assets whose value doesn't depend on dollar stability. Gold is one, real estate is partially protected, and Bitcoin, mathematically scarce, globally accessible, outside any central bank's control, is positioned to capture flows seeking refuge from dollar devaluation. The 2.4% allocation isn't a speculation. It's a hedge against Bridgewater's own macro thesis, a thesis that predicts the dollar-based financial system will undergo forced restructuring within the time frame of current investment horizons. This is where the lie becomes unsustainable. Dalio's public statements about Bitcoin have served a purpose, managing his reputation within the traditional financial establishment. Bridgewater's clients include sovereign wealth funds, central banks, and institutional investors whose mandates often prohibit cryptocurrency exposure. Publicly endorsing Bitcoin would create friction with these clients. The private accumulation serves a different purpose, positioning Bridgewater's capital for the scenario their analysis considers most likely. The gap between public statements and private action isn't hypocrisy, it's institutional strategy. Dalio says what his clients want to hear while doing what his models recommend. The paper versus physical distinction matters enormously in Bridgewater's positioning. The Form ADV specifies direct holdings, not ETF exposure, not futures positions, not claims on Bitcoin held by third parties. Bridgewater holds actual Bitcoin in wallets they control. This specificity is not accidental. Bridgewater's risk management is legendary. They don't take exposures they don't understand. They don't accept counterparty risks they can't quantify. If they're holding Bitcoin directly, rather than through institutional products, they've concluded that direct holding provides properties that indirect exposure doesn't. Those properties are the properties of self-custody, censorship resistance, seizure immunity, independence from institutional intermediaries. Bridgewater, the most institutionally connected fund in the world, is holding Bitcoin in a way that doesn't depend on institutions. The apparent contradiction dissolves when you understand what Bridgewater is hedging against. If the monetary restructuring their analysis predicts involves capital controls, asset freezes, or forced conversion of financial assets into government instruments, scenarios that have occurred in previous debt cycle endings, then Bitcoin held through institutions provides no protection. Only Bitcoin held directly, in wallets the fund controls, survives those scenarios intact. Bridgewater is hedging against the failure of the financial system they operate within. The direct holdings are insurance against a world where institutional exposure becomes a liability rather than a convenience. At 3:15 p.m. Eastern on January 24th, 9 days after the Form ADV was filed, Bloomberg reported that Ray Dalio had agreed to a wide-ranging interview about markets and monetary policy, scheduled for broadcast on February 3rd. The interview would address Mr. Dalio's current views on portfolio construction, currency dynamics, and alternative assets. The timing is not coincidental. The Form ADV is public record. Sophisticated investors had already noticed the $2.33 billion Bitcoin position. The interview is Dalio's opportunity to address the discrepancy between his public statements and his fund's actual positioning, to construct a narrative that explains the apparent contradiction. The preview clips, released by Bloomberg on January 28th, suggest the narrative Dalio will offer. In one clip, he says, "My thinking on Bitcoin has evolved. The asset has demonstrated resilience I didn't anticipate, and the monetary environment has developed in ways that increase its utility as a portfolio diversifier." Evolved. Demonstrated resilience. Portfolio diversifier. The language is careful, acknowledging the position without fully endorsing the asset, maintaining distance from Bitcoin maximalism while justifying significant allocation. But the language also contradicts his November 2025 claim that his position was very small and not significant. A 2.4% allocation to a single asset in a $97 billion fund is significant by any reasonable definition. The evolution he describes didn't happen between November and January. The position was being built throughout 2025, invisible until the annual Form ADV disclosure made it public. Dalio was accumulating while saying he wasn't. The evolution he describes is not in his thinking, it's in what he's willing to admit. When institutions do what they're doing now, they're not speculating. They're preparing for scenarios their public personas cannot acknowledge. At 10:30 a.m. Eastern on January 27th, pension fund consultant Cambridge Associates published their quarterly asset allocation guidance. The guidance, distributed to institutional clients managing combined assets exceeding $4 trillion, included a new section on digital asset considerations. The section recommended that institutional investors evaluate direct cryptocurrency exposure as a component of tail risk hedging strategies, with allocations of 1 to 3% appropriate for portfolios with long time horizons and tolerance for volatility. 1 to 3%, the same range as Bridgewater's 2.4% position. The recommendation doesn't mention Bridgewater by name, but the timing, published 12 days after Bridgewater's Form ADV revealed their position, suggests coordination, or at least awareness. Cambridge Associates advises pension funds, endowments, and foundations whose investment decisions move billions. Their guidance creates permission structures, allowing institutional allocators to consider positions they might otherwise avoid. The guidance effectively tells institutions, Bridgewater is doing this and you can too. The pension fund flows that follow such guidance take months to materialize. Investment committees must meet, policies must be amended, custodial arrangements must be established. But the guidance initiates a process that, once begun, moves substantial capital. If even 1% of the $4 trillion advised by Cambridge Associates flows into Bitcoin following their recommendation, that's $40 billion in new demand. Against a total Bitcoin market cap of approximately $1.9 trillion, $40 billion represents 2.1% of total value, a demand surge that would materially impact prices. The institutional cascade that began with Bridgewater's disclosure is just beginning. The Form ADV was the domino that started falling. The Cambridge Associates guidance was the second domino. The pension fund allocations that follow will be the third, fourth, fifth. Less than 60 days remain before the Q1 2026 institutional rebalancing window, when pension funds typically implement strategic allocation changes adopted during policy reviews. The Bridgewater disclosure arrived in time to inform those reviews. The Cambridge Associates guidance arrived in time to provide cover. The Bitcoin positions that result will execute in March. The countdown is not to a single event, but to a process. Institutional capital flowing into an asset class that most institutions have avoided, guided by the example of the largest hedge fund in the world and the blessing of the most influential pension consultant. While Western institutions discover Bitcoin, Eastern institutions are already positioned. At 7 a.m. Beijing time on January 26th, 6 p.m. Eastern the previous day, the Hong Kong Monetary Authority published updated guidance for cryptocurrency investment by licensed financial institutions. The guidance increased permissible cryptocurrency allocation from 1% to 5% of assets under management for Hong Kong licensed wealth managers. The increase was justified by maturing market infrastructure and enhanced institutional custody solutions. Hong Kong manages approximately $4.5 trillion in assets through its licensed wealth management industry. A shift from 1% to 5% permissible allocation unlocks an additional $180 billion in potential cryptocurrency investment, not required investment, but investment that institutions can now make without regulatory constraint. The timing aligns with Bridgewater's disclosure. The Hong Kong guidance was finalized in December 2025, but published in late January, after the Form ADV made Bridgewater's position public. Hong Kong regulators were watching Western institutional behavior and adjusting their framework to remain competitive. Singapore has maintained 5% permissible allocation since 2024. Dubai permits even higher allocations under VARA's framework. The Asian financial centers that compete for global capital are systematically removing barriers to cryptocurrency investment, creating regulatory environments that welcome flows Western institutions are now ready to provide. The geographic arbitrage is straightforward. Institutions that face constraints in Western jurisdictions can access cryptocurrency exposure through Asian vehicles. The capital flows to where the regulatory environment accommodates it. Dalio has spoken publicly about this dynamic. In a 2024 interview, he noted, "Capital flows to where it's treated best. If Western jurisdictions create obstacles, capital simply moves to jurisdictions that don't." The observation applies to his own fund's positioning. Bridgewater's direct Bitcoin holdings may well be custodied in jurisdictions with more favorable regulatory treatment than the United States. The BRICS nations' approach to cryptocurrency adds another layer to the geographic picture. The January summit produced working papers on digital reserve diversification that explicitly mentioned Bitcoin alongside central bank digital currencies. The papers proposed that member nations explore sovereign holdings of decentralized digital assets as components of national reserve strategies. Sovereign Bitcoin holdings, central banks owning cryptocurrency directly. The concept seemed fringe when El Salvador adopted it in 2021. The concept became mainstream when BRICS, representing 46% of global population, began discussing it as policy. The demand that Dalio's thesis anticipates, flows seeking refuge from dollar devaluation, would come not just from institutional investors, but from sovereign entities themselves. Central banks that have accumulated dollar reserves for decades are reassessing that accumulation as dollar instability becomes more visible. If sovereign wealth funds and central banks begin allocating to Bitcoin following the BRICS working papers framework, the demand surge dwarfs anything institutional investors alone could generate. The combined reserves of BRICS nations exceed $6 trillion. Even a 1% allocation to Bitcoin would exceed the entire current market cap. This is what a system looks like when it reaches an inflection point. Dalio's framework, the long-term debt cycle, the inevitable restructuring, the currency devaluation that follows, describes a system approaching the end of its current configuration. The Bitcoin allocation isn't a bet that cryptocurrency replaces the dollar. It's a bet that the dollar's current configuration cannot survive its debt burden, and that assets outside the dollar system will preserve value through the reconfiguration. The trap has no exit for those who remain fully allocated to dollar-denominated assets. If Bridgewater's analysis is correct, if 40 to 60% devaluation over the next decade is the most likely scenario, then cash loses 40 to 60% of purchasing power. Bonds lose similarly, plus any capital losses from rising rates. Equities partially hedge but remain denominated in the devaluing currency. Only assets outside the dollar system fully escape. Gold preserves purchasing power through currency devaluations. It has for millennia. Real assets, real estate, commodities, productive land, preserve value in real terms even as nominal prices adjust. And Bitcoin, if it maintains its properties, if the network continues functioning, if adoption continues spreading, captures the digital component of the flight from fiat. The portion of global wealth that exists digitally, that moves electronically, that operates through internet-connected systems rather than physical possession, needs a destination that isn't dollar-denominated. Bitcoin provides that destination. Not perfectly, not without volatility, not without risks that Dalio has enumerated in his public statements. But the allocation exists because, on balance, Bridgewater's analysis concludes the asymmetric upside exceeds the downside risks. The question Ray Dalio asks prospective clients, "How many Bitcoin are you holding right now?" isn't rhetorical anymore. It's diagnostic. The answer reveals whether the investor understands the monetary dynamics Bridgewater's analysis describes, or whether they remain positioned for a dollar-centric world that Bridgewater believes is ending. The 2.4% allocation is Bridgewater's answer to their own question. Not zero, the answer of those who dismiss Bitcoin entirely. Not 50%, the answer of maximalists who see nothing else. 2.4%, the answer of sophisticated risk managers who want exposure to an asset that benefits from dollar weakness without betting the fund on any single outcome. The forecast implicit in this allocation is not a price target. Dalio has consistently refused to offer Bitcoin price predictions, even in private conversations. The forecast is structural. The dollar-based monetary system will reconfigure. That reconfiguration will devalue dollar-denominated assets, and Bitcoin represents one vehicle for preserving value through that reconfiguration. The 2026 timeframe is significant because it marks the window when the structural pressures Bridgewater identifies become acute. U.S. debt exceeds $37 trillion. Annual deficits exceed $2 trillion. Interest expense exceeds $1.1 trillion, consuming more than defense spending, approaching Social Security as the largest budget item. The mathematics of debt service become visibly unsustainable within the next 12 to 24 months. The policy response to unsustainable debt determines how the restructuring unfolds. Default is politically impossible. Explicit austerity is electorally impossible. The remaining option, monetary expansion that devalues the debt in real terms while maintaining nominal obligations, is the path of least resistance. Bridgewater's analysis apparently concludes this path will be taken. The 2.4% Bitcoin allocation hedges against its consequences. Reality asserts itself through filings that reveal what words obscure. Ray Dalio spent 5 years publicly questioning Bitcoin while privately accumulating $2.33 billion of it. The discrepancy is now documented, filed with regulators, available for anyone who reads Form ADV page 612. The question he asks, "How many Bitcoin are you holding right now?" deserves a thoughtful answer. Not because Dalio is always right, not because Bridgewater's analysis is infallible, but because the largest hedge fund in the world, run by one of the most successful macro investors in history, has concluded that some Bitcoin exposure is prudent, given their assessment of monetary dynamics. The sophisticated response to this conclusion isn't to mirror Bridgewater's position exactly. It's to understand why they hold what they hold, assess whether their reasoning applies to your circumstances, and position accordingly. Their reasoning: the dollar-based monetary system is approaching structural limits that will force reconfiguration. That reconfiguration will devalue dollar-denominated assets. Assets outside the dollar system, including Bitcoin, will preserve value through the reconfiguration. Their position: 2.4% of portfolio in direct Bitcoin holdings, self-custodied, outside institutional intermediaries. Their behavior: accumulating throughout 2025 while publicly minimizing the position, disclosing only when SEC filings required disclosure. The gap between their words and their actions tells you which to believe. The words served reputation management. The actions serve capital preservation. The February 3rd interview will offer Dalio's explanation for the discrepancy. The explanation will be carefully constructed, probably compelling, certainly quotable. The financial media will report it as Dalio's evolved thinking, or his new perspective on cryptocurrency. But the Form ADV tells you everything you need to know before the interview airs. Bridgewater holds $2.33 billion in Bitcoin. The position exists because their analysis recommends it. The analysis apparently predicts dollar weakness severe enough to justify meaningful allocation to an asset outside the dollar system. The interview will explain. The filing already reveals. How many Bitcoin are you holding right now? Bridgewater's answer: $2.33 billion worth, in direct self-custody, positioned for dollar devaluation their models predict. Your answer is the variable that remains undetermined. The question isn't what Dalio thinks you should hold. The question is what you think, given what Dalio's own position reveals about what the most sophisticated analysis in the world concludes about where the monetary system is heading. The Form ADV is public record. Page 612. The number is there. The position is real. The forecast it implies is structural, not speculative. Dalio asked the question. Bridgewater answered with 9 zeros. The remaining question is how you answer, and whether your answer reflects understanding of the same dynamics that moved $2.33 billion into direct Bitcoin custody at the world's largest hedge fund. The filing exists. The position exists. The forecast exists. What exists in your portfolio is still up to you, but the question has been asked. And the asker's own answer, $2.33 billion, direct custody, outside the dollar system, tells you more than any interview ever could.